Hello everyone, this is the Smart Money Technician and welcome to today's video. In today's video, we are going to be discussing combining ICT and quarterly theory for pinpoint directional accuracy. Okay, so in this video, we're going to combine some ICT concepts, not all of them, and of course quarterly theory, and we are going to use it to help us, aid us in picking the direction that the market is going to go into. So let's get into today's video. The first thing that we need to know is that each time frame has its specific function in terms of the price signatures that we are going to use on that time frame. Certain time frame have specific signatures that we are going to weight more on that specific time frame than on another time frame. For example, when it comes to SMTs, I'm obviously not, as a day trader, going to focus on the yearly cycle sequential SMT, although it can give me a long-term expectation on which direction the market will go into. But specific timeframes, we're going to weight specific signatures more than others. So on the weekly time frame, it is used at the market opening for analysis. In other words, when the market opens on a Sunday, that opening price, that is when you begin your analysis on the weekly time frame. And the things that you look for on this time frame is SMTs, TPDs, old highs, old lows, and imbalances, which are fair value gaps. All right. Now, the daily time frame is used at the start of every day, right? And primarily, you use this time frame to frame higher time frame key levels, which are our imbalances. You will then look for TPDs on the daily time frame if they are there, or old highs and old lows. And just for reference, not all of these things are going to be in the marketplace at the time of your analysis. You have to work with whatever the market is giving you at the time of your analysis. All right. So the next thing is the 4-hour time frame, and the 4-hour time frame will be used to spot SMPs, of course, on the monthly cycle, TPDs, specifically the 2 a.m. candle, and then a market maker model if you see one there. All right. And then the 1-hour time frame, you're going to use it to spot SMT on the weekly cycle, TPD specifically on the 7 a.m., 8 a.m., 9 a.m., and sometimes the 10 a.m. candle. But take it from me, the highest probability is the 8 a.m. and 9 a.m. 1-hour TPD. These are the best TPDs to spot a reversal intraday. So let's get into it. So right now we are starting off on the weekly time frame, and you can see we obviously are going to look for an old low or an old high imbalances, but over here you can see that there are no imbalances to work with. So right now we just see that this old low was taken out here, and it was also taken out here, but over here it failed to take it out. So we can see that this is an SMT divergence. It is giving us an indication that the market, as price was trading lower here for a couple of weeks, this indicates to us that the market wants to turn. But this SMT is also a very powerful SMT because we can see that this low is the low of October, and during November we take that low out here and we take it out here, but failed to take it out over here. This is SMT between the current month and the previous month. This SMT does not fall inside of quarterly theory. It falls inside of doubling theory. It is a very powerful SMT when it occurs because it can give us a directional bias for a couple of weeks. And whenever you now have an anticipated direction that you expect the market to go, in this case we see that we are taking the lows and we want to expect price to go higher, you then look to the opposite direction of the market where the market can trade into. Are there any imbalances that exist there, or are they old highs and old lows? The only thing that we have is these old highs right here. But what is special about these old highs is that they are unsymmetrical highs, or what we like to call SMT highs. An SMT high is a high probability draw on liquidity, just as a relatively equal high is. So whenever you have this, you know that this is a high probability that price will draw into this level. The next time frame then we go to is the daily time frame. So over here we can see that we have framed our direction, and this time frame we use it to mark higher time frame PD arrays that price can give us bounces off of, and we also use it to draw liquidities and imbalances that can be used for targeting purposes. So let's say we were trading on this day and we saw that we were relatively close to these highs over here. Those highs for that particular day can be a target. The next day, you can see that we have the remainder of this gap inside here. And if we were bullish, we would then expect that price for that day will fill in that gap, and that would be our target, as you can see over there. So this is what this time frame primarily is used for. You can also use it, as you can see over here, there was a fair value gap, a bullish one, and price opened, rallied into it, and then expanded higher. So it can also be used to frame a PD array for a continuation. All right, now we go into the 4-hour time frame. So on the 4-hour time frame, as I said, this time frame, you use it to mark PD arrays like the imbalances, but you can also mark a market maker model. So over here, you can see as price traded into that higher time frame level that we had marked, as you can see, where we had the SMT to indicate higher prices. If you go to the 4-hour time frame and you see a market maker model consolidation, it expands away from the consolidation, tries to return back to that consolidation, expands again, tries to return, expands, trades into that key level on our weekly time frame, giving us the SMT, and you can see that a market maker model is forming, then you know that this is a very, very high probability directional bias because it now is accompanied by a market maker model. On this time frame, we don't see any monthly cycle sequential SMT. We have to work with what the market is giving us at the time. So this is what the market gives us. We also have a 4-hour gap, and if you scroll a little bit more to the right, you'll see there was another gap over there, which we will get into. Now we are on the 1-hour time frame, and I said that the 1-hour time frame, you can use it to mark imbalances, but also TPDs on the 8 a.m. and the 9 a.m. candle, also the 7 and the 10 a.m. as well. As you can see, if you look closely here, these are TPDs that I marked with these arrows over here. So on this day, there was a TPD. This other day, there was another TPD. And even if you look closely here, I did not mark that, but there was also a TPD right here. So you could use that for a continuation in your direction. But now we're going to show you how we are going to enter into these trades, because of course, it's no point having a directional bias if you're not able to trade in line with that bias. So SMT and TPD fair value gap time frame alignment for a day trader. Notice I say for a day trader. I'm not going to give the other time frame alignments as it is irrelevant if you are a day trader, but you can reverse engineer everything I say to get what it would be if you are a swing trader or another type of trader. So over here, you can see that we have a 4-hour gap. So anytime you have a 4-hour gap, and before I say this, the first thing you need to know is that price has already expanded in your direction, and you already have a pre-existing bias. In this case, you are going to be using a fair value gap as a continuation. So let's say you have a 4-hour fair value gap and price retraces into that 4-hour fair value gap. You can expect two things to happen, one of two things, or even both. You can either expect within that 4-hour TPD, within that 4-hour fair value gap, a 1-hour TPD to form inside of it, and then price will give a continuation move, or a daily cycle sequential SMT. You understand? If you had a 1-hour gap, you can expect an M15 TPD to form inside of it, or a 90-minute cycle sequential SMT. All right, so let's show you how these work. So over here on Monday, we had the anticipated bias, of course, and then we had a daily cycle sequential SMT form, as you can see over here. But some of you may notice that this sequential SMT over here takes out the low, but it also does not close below the low. And if you did identify that, you'd be correct in identifying that, because it is supposed to close below the low. But the reason why it doesn't do this in this case is because this is actually a 2-stage sequential SMT. So if you also go to the 5-minute time frame to view the 90-minute cycle sequential SMT, you will see that the 90-minute cycle sequential SMT over here does close over it. So this is Dow Jones. This is the low of the previous quarter in the 90-minute cycle. And you can see that price closes below that low, while over here it fails to even trade to that low. Okay, so when you have a 2-stage sequential SMT, only one of the stages needs to give the close below the previous quarter's low. All right, so as that happens, you would obviously enter inside here, and you can put your stop loss at any one of these lows over here, right? Because you can see price expanded in your direction as it was retracing over here. Here it was giving a run below the low of the previous quarter. You could have bought there and put your stop loss below the low, and that is how you would trade the bias going into Monday. On a Tuesday, you can see this level over here is a 1-hour fair value gap. And what did I say? whenever you have a 1 hour fair value gap, you can expect either a 90-minute cycle sequential SMT or an M15 TPD to form on it for a continuation. Notice I say for a continuation because price has to have already expanded in your direction in order for this fair value gap to have formed in the first place. All right, so when the TPD form, we will not expect candle number 3 in the TPD sequence to trade below candle number 2, which is the TPD, because this is a fresh fair value gap that it formed on. All right, so as the TPD formed and you see price over here opens rallying down, you could have buy in that and put your stop below the low of the TPD and ride the price in the direction that it expands into. All right, so this is how you would have traded Tuesday. There was no sequential S&P, but this is a way that you can trade it as a continuation. Okay, on Wednesday, now on Wednesday, if you look at this level over here, this is a 4-hour fair value gap, and then a TPD forms on that 4-hour fair value gap right here. Now I know what some of you are thinking. Did you not just say that candle number 3 will likely not trade below the low of candle number 2 if it forms on a fair value gap? I said a fresh fair value gap. So this is not a fresh fair value gap because, as you can see over here, price trades into the level and then trades out of it, trades into the level and then trades out of it, and then trades back into it, forms the TPD. When this happens, you are going to watch very carefully to see in one of the 3 assets if candle number 3 is going to trade below the low of candle number 2. And as you can see, it does so in ES and NQ, which is NASDAQ and S&P 500. But in Dow Jones, it fails to do so. So you can immediately, as you see this happening on these 2 Dow Jones, you buy somewhere while that is happening, put your stop below candle number 2, which is the TPD, and you would obviously ride it for easy 1:2, 1:3, as you can see. So this is how you would trade these things in line with the bias, right? What happens the rest of the week? Monday was a good trading day. Tuesday was a good trading day. Wednesday was a bit tricky. If you had experience, you would be able to capitalize off the buy as well. What happens on Thursday? You can see Thursday just consolidates. So whenever you have 3 good trading days that are in your direction, the 4th trading day would be a 50-50 because you can either expect price to consolidate or reverse. It's a very, very slim chance that it even expands in your direction. If it does, it might even be very lackluster. So a day like this, you would be on the sidelines. So it consolidates. And then on Friday, you could see that from Monday, we traded higher. So Friday, you would expect the market to trade back inside the range for a short-term reversal. And as you can see over here, price gives a reversal back into the range on a Friday. So thank you for listening to today's video. As you can see, this is very simple. The thing that you are doing is you are using the weekly time frame to be able to get your direction. And notice what I said in this video at the start of the video. I pointed out the doubling theory SMT between the months, between the current month and the previous month. Whenever you have this kind of SMT, a second SMT to confirm this is not necessary because this SMT that occurs over here is doubling theory. It's a special kind of SMT that happens once in a while where we take out the previous month's low so it can give you a bias for the next couple of weeks. So this will be the targets going into the future. Thank you, and I hope you guys enjoyed the video. Make sure you like, comment, and subscribe. Peace out.